From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
All right, it's Friday, May 8th, 2020 on the HPS Macrocast. Tony Fratto coming to you from Southwestern Pennsylvania. Matt McDonald from HPS is in our Washington, D.C. office. John Fagan and Brendan Walsh are co-conspirators from Markets Policy Partners are in the Washington, D.C. area as well. And we're coming to you on I guess we have to call it a historic jobs day. It is a historic jobs day. The numbers are pretty dramatic. And I won't say that they were in some ways not unexpected. But Matt, why don't you take us through the numbers? And then, I think we knew that the numbers were going to be bad, and we knew there's going to be a lot of noise in them. And we'll get a chance to get through all of those. But why don't you take us through what we've seen so far?
Yeah. So the April jobs report from BLS reported total non-farm payroll going down by 20.5 million in April. That brought the unemployment rate up to 14.7%. And just to put that in context, BLS has been running these official numbers since the 40s. This is the highest rate in the modern collection of unemployment data. You have to go back to the Great Depression, where estimates are a quarter, around close to 25% of the workforce was unemployed to get numbers this high. So this is a record in that sense. It is likely going to get worse. So when you look at it's worth a little bit of how the mechanics on some of this work. There's multiple surveys that BLS runs. The surveys are run during the week that contains the 12th of the month. So that is actually several weeks ago. When you look at the unemployment claims since kind of the beginning of this crisis, unemployment claims show the latest data shows a total of 33 million filing for unemployment since the crisis began. So the decline of 20.5 and where we are in this stuff, it's probably going to get worse. It's worth going into when I look at the underlying data, it's probably worth looking at it through the lens of industry to get a sense for what's getting impacted and how much and that sort of thing. I looked at some of the demographic information is interesting, but basically everybody's getting hammered. There's not kind of a disproportionate difference as compared to industry, where there is a lot of difference, and it's worth calling out just a few of these. Leisure and hospitality as a sector, that has lost about half the jobs in that sector.
Makes you wonder what the other half are doing right now.
Yeah,
I'm not aware of anything really running and opening. Right?
Yeah. What's some other stuff that's interesting? Child daycare services down by about a third. Dental offices, which is interesting. I think it's down by a little over a half. That is, that's an interesting dimension of healthcare. There's kind of a quirky part of healthcare where, as much as healthcare is central to the moment we're in, anything that is kind of discretionary seems to have fallen by the wayside on that score. Air transportation as a sector, that's down 27%. I actually would have thought that would have been higher.
Yeah.
And then you get some of the, you actually have sectors that are growing. So, we've talked about in the past, Walmart and Amazon hiring up. The biggest gaining sector with almost 100,000 jobs, 5% increase, is the sector general merchandise stores, including warehouse clubs and supercenters. But coming in at second is monetary authorities, the central bank increasing by 2%.
It's second. That's amazing.
Well, of course, that's the only thing that's holding up the economy right now. So
exactly.
John and Brendan, so we definitely want to go into these numbers, but also, markets, they were expecting something in this range. Futures were pointing up. They're going to open shortly, and who knows what the day will end up. But no market participants were surprised by these numbers, were they?
No, this is, everyone knew from the claims. What is it? About 1.1 million claims is equivalent to about a percent on the unemployment rate. So everyone knew that, somewhere between 20 and 25% of the population was out of work. I think the interesting part, which people were aware of too, but it was hard to judge exactly how much wages were going to go up because, the federal government is subsidizing the unemployment claims. So you get an extra $600. So 40% of the population or so is actually making more money being unemployed than they were before,
right.
Which was the intended part.
Yeah, but that doesn't count as wages, though, right? I mean, so I think the reason wages went up was low-income people being moved over to unemployment, right?
Unemployment, yeah.
Right. So higher wage people were making up a greater share of the workforce.
Yes. Yeah,
right. So wages go up. Yeah. I refer to this as the yeah but jobs report. Right. Like for every data point that you mentioned, whether it's so that 20.5 million jobs. Yeah, but we also know that a lot of people are being paid through PPP to not work as well, right? So we know that the number, right, the effective
it's
number.
It's a really important point. We don't want people working right now.
No.
This was the whole purpose of this.
Yeah. So it is really noisy. I mean, Matt talked about some of the effects there. BLS actually. BLS actually, sort of put a note with the report, essentially saying that, if you counted people who were not, who were not working and, but not looking for work, the true number is something in the range of, 19 or 20%. So 1 out of 5.
Yeah, an extra 5% on the unemployment rate that shows exactly. But this is a really good data point where 18.1 million people classified themselves as temporarily laid off. So that's people that are expecting to go back to work, once they're allowed to. So that's a great sign. We just hope that those businesses are there for them when they do go back.
Yeah, some of the so it's an interesting point. This is one of the this is odd, right? I mean, usually you go into a recession. We obviously don't condense. What we're doing here is condensing all of the the job losses in a normal recession into a matter of weeks rather than what usually would be months. So it was all shut down the economy, and this happens very quickly. Usually, people are pretty sour about their employment prospects in the future when they're unemployed during a normal recession. Here we have some polling showing that something like 70% of people expect to be back working in their old jobs in 6 months. Mm-hmm. That is a very different dynamic, and who's to say whether they're right or not? We don't know whether they're right or not, right? We have no, and we have no reason to believe that they have a good idea too. We hope that's the case. But I think that there is a feeling out there, and I do want to talk about the markets a little bit, right? Just sort of a view that things are we're in the darkest point of the tunnel, and we're gonna come out of the tunnel. We all want to believe that at some point in the future we're going to get back to normal, but it's hard to believe that you dig a hole this deep, and that normal, when the next time we feel anything like normal, is going to be back at the old levels of economic activity that we were experiencing in January and February. It just seems like we have many, a year from now, we're still going to be talking about digging out of this hole. John, is that what you're? Do you think markets are seeing that way?
Yeah, thanks, Tony. It really is a situation in which the headline grabbing market is always the S&P 500 and the NASDAQ, U.S. equities. And because those are getting the headlines, if you're just focused there, then the message is pretty optimistic. We just saw yesterday the NASDAQ go positive on the year. It's up 4.5% on the year. And that is telling you, well, we're, V-shaped recovery, things are snapping back, and they're good for the NASDAQ companies. The S&P 500 is still down about 10% on the year, but that's a 10% on the year. That's pretty garden variety in terms of downside. But then if you start looking at other markets, and broadening your view across global financial markets, it's a lot more nuanced. And even if you look, even if you only glance as far as small cap stocks, if you look at the Russell 2000, which is smaller businesses, that's still down 23% on the year, and more from its high of February. And then if you cast a glance over at the Treasury market, the pricing there is consistent with an extremely long slog through an economic trough. The 10-year Treasury yield is at 66 basis points or 62. It's exceptionally low. And we just saw yesterday the Fed Fund futures market is projecting for the very first time ever negative policy rates by the Fed. The December 2020 and January 2021 contract dipped, not deeply, but they dipped into negative interest rate policy territory. And that is not consistent.
And that means you get paid to borrow, right?
Well, we have negative interest rate policy, just for context, is in place in a lot of Europe, in the EU, and in Japan, most notably. The Fed has been a little bit. The Fed has generally expressed reservations broadly about negative interest rate policy, but the fact that the rates market, the Fed Fund futures market, is projecting this way out in January is not a vote of confidence from that particular market that we're going to have good economic outcomes. Commodities remain depressed. So we've cautioned before about focusing too much on the headline grabbing sort of index increases in U.S. equities as giving the only story from global financial markets.
I want to touch on the shape of the back end of this, the recovery, because the discussion on this I don't think has been super helpful, because in some levels it's not specific enough. Like my theory of this, if you want to describe a shape, it's a mirror image of a square root sign. So you're going to have it's high. It's going to spike down, it's going to spike up, and on the back end, it's going to be lower. You're not going to be able to have like Q2 be like negative annualized 30% GDP and then 0, 0, 0, 0 even after reopening. That's not how this is going to work. It's also not going to be plus 30% GDP in Q3, right? Like a complete snapback. The question is like, there's going to be a quote unquote V. The V is not going to go up as much on the back end as it's going to go down on the front end. So the question is like, how much does it go back up, and how much do we have to recover on the back end, and what does that look like?
Yeah, well, and over what period too?
That's right. John.
Yeah, and if you're taking the equity market at face value, it's separating winners and losers out. And the idea is, and we saw this in earnings season, there are winners from the pandemic, and it's something that management wouldn't necessarily ballyhoo on their call. And we've seen obviously Amazon and some other companies plowing some of that profit back into employee protection and customer protection and that sort of thing. To accept this new reality might be with us for a long time, but this is a situation in which in the longer tail, there are some of these big companies are just going to get bigger, and Amazon's dominance is it's hard to see that trend slowing. Netflix, the streamers, the other winners of this are pretty clear.
Is that the answer? Is that what you're saying specifically with respect to NASDAQ, John? I'm like, why NASDAQ is like it's come back completely entirely. on the year. It's mostly made up of or heavily weighted toward those, those firms who have been able to do okay through this period.
Sure. Yeah. And when you look at the high profile winners, they are concentrated in the tech space. You hear, Facebook, the number of, the users on social media it's not surprising that they're going up, and, they may be losing on some ad revenue. We saw Netflix, their subscribers jumped enormously, and they cautioned about extrapolating that trend, but it's still it is very concentrated in tech.
PayPal was a similar example where their first quarter earnings were kind of blah, but they had a massive spike in new users. So that's all that matters. And this pandemic is going to kind of accelerate certain technological innovations that we were somewhat slow to do. Like, we're doing this on a Zoom. I would imagine we're going to do a lot more meetings on Zooms rather than get on a plane and go meet somebody face to face.
I have been shocked. I've been shocked both on the official announcements and anecdotally of how many companies are thinking about totally rethinking their real estate footprint and what that looks like.
Yeah. So one of our
back end commercial real estate, there's a lot of fallout, it feels like to me, coming for that sector.
So it's a UK clothing store, and they were always very against working from home, but with HR is allowed to kind of like track how your productivity on your computer and things like that. And what they found is people are much more productive at home than they are at work. So they've completely switched. They said when things go back to work normal, they're going to demand people spend 2 days a week working from home.
Yeah, I don't know if that's going to carry over, though. I'll be honest with you.
I know. I don't know either.
Yeah, I mean, working from home in the middle of a crisis when, without rules, right? Like, I mean, the thing about going to the office and going to work is you generally are working within working hours, and people are reluctant to expect you to be working, very early in the morning or in the evening for a lot of jobs. I mean, I've mostly in jobs where you're always working, but for most people, they're working within the bounds of their commutes to work. And so, yeah, they're more productive at home because probably they're not punching a clock, they're just working as they work. And I suppose there'll be some work from home rules that would create some boundaries for people in that future as well. But that's right. I mean, look, there are going to be a lot of these changes, and that's why I keep trying to say that it's why in some ways I never question the markets, right? It's like, it's millions and millions of people, the accumulated knowledge that they have, and it just is what it is. So I'm not saying the market's stupid. I'm just saying I don't see the future that they seem to see. Yeah. Because I see, I don't know how much less economic activity we're going to be doing in 2 years, but it is going to be less. I don't see how it's going to be, more than what we were doing in January and February. Forget about even just the wealth loss. We had companies like, J. Crew, Neiman Marcus file for bankruptcy, right? There's like value destruction there. It's going to have implications for commercial real estate and lots of other things. And that's happening. We saw a lot of that. We're going to see a lot more of it. So not even forgetting that, but just like these, changes. So it's like, yeah, it's maybe great for Zoom. And if you own stock in Zoom, you're great, right? But it's really bad for airlines. So, it's so that the idea that we're going to be back at, just sort of normal GDP measures, that we're going to get back to that level, it just seems, I don't see it. I mean, the employment population ratio right now, it went from, it doesn't sound like a lot unless you pay attention to these numbers, right? But from 61% in February to 51%, right? A 10% drop in the employment population ratio is crazy, right? When people get out of the habit of working, even for short periods of time. It takes them a long time sometimes to get back into the workforce and go to work. So I just think this is going to be a longer slog than I think people market.
I think it is fair to say that forecasting in this current situation is a difficult exercise.
Yeah, because we always say that the market isn't the economy, but the market does predict what the economy is supposed to be kind of in the future. And I think the disconnect between what is being shown in the equity market and what we're seeing on the ground, I've never seen a larger, not necessarily disconnect, but a gap. Because this time the virus is in charge, and none of us are virologists. So it's a battle between human ingenuity and the virus, and whether that takes 3 months, 6 months, 12 months, or 20 months, it's very difficult to predict.
Yeah, definitely. Well, look, and the way I think about it is, these are. Not to quote Rumsfeld with his known knowns and known unknowns. These numbers today, I was very anxious about seeing them, just knowing how bad they were going to be and big. And so, but that was a known, right? We knew the numbers were going to be really bad. We expected it. Market participants expected it. The known unknown, I think, is much more frightening, and that's this question of, what does the comeback look like? When are people going to feel comfortable? Have there been structural changes in the way people live their lives as economic actors, and what we spend our money on? What are going to be sort of those permanent shifts? And it has consequences for a lot of sectors. And we're going to take a break and come back and talk about one of those sectors where the demand is going to play is playing a huge role and will in the future now, and that's with oil. So I'm going to come back and take another look at what's happening with oil this week, and what we think about the future of that sector. You're listening to the HPS Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
And we're back on the Macrocast. John, we saw a little, rally back with oil this week. What's going on there? What are traders seeing?
Yeah, the week before it was the opposite story. It was a incredibly another headline grabbing moment in markets, where oil prices, the front month future, the May future, went negative a little while ago as traders scrambled to try to get out of any physical delivery, given the fact that U.S. storage around the world for crude oil is brimming, given the supply glut and collapsing demand. It's been a very bad dynamic, bad balance in the market. We have seen, just for context, Saudi Arabia and Russia bury the hatchet on their price war, and OPEC and its allies come together to redouble their efforts to squeeze output tighter in an attempt to achieve a better balance of supply and demand. But still, coming into this week, oil prices and Brent crude, the international benchmark, was languishing at 20-year lows. But it bounced up earlier this week, and really that spilled over into broader sentiment. Traders and analysts, as we said, the theme of uncertainty, they're groping for anything that might give them some sort of hint as to the trajectory of the recovery. And the fact that oil prices started to bounce, it was kind of a chicken and egg thing, but it gave an added level of confidence. If oil prices are bouncing up, then maybe things aren't going to be so bad. And there were some indications that demand is picking up. We saw some of that in the earnings from the oil majors, and we've seen that in some of the Gas Buddy has like weekly sales trends, which you can monitor, and those have improved. So yeah, the demand picture looked better, and prices bounced up from 2-decade lows, but kind of stalled out here. And this is the oil prices. Anybody that trades oil knows that rallies in oil can be self-defeating. Basically, if you get higher prices, then there are all these tankers out there bobbing around,
ready to deliver.
Yeah, they're just waiting to sell it, right?
They're ready to splash that surplus into the market to knock the prices back down. So there's probably a ceiling on oil prices here, and the rally can only go so far. I think Goldman put the top around 30, which is where just above that is where Brent turned and retreated yesterday. So we're seeing it chopping around those levels, but at least it's not bottom feeding.
Yeah, I've seen reports that basically anything below $35, we're going to lose half of our oil companies. They just can't produce at that level.
I mean, this kind of goes back to the discussion around the gap between the markets and the real economy. I mean, until there's actually people driving and making stuff and doing things with the oil, it's an exercise in market movement. It's not, there's not a place for this stuff to go. I mean, back to the forecasting aspect is that, the health forecasting on when this is going to end hasn't been great. You factor in that error rate by the usual error rate of economic forecasting, and we're at pretty much garbage in, garbage out. Like we don't know when this stuff is really going to open up, or for how long, or if there's going to be a second wave or any of that stuff. It's just very difficult.
And this time is unique too, because policymakers, the governor can say you can go back to doing things, you can go to a restaurant, but people aren't necessarily going to follow that,
Mm-hmm.
Yeah, and to Matt, to the point you were making earlier too about changing the economy. So yes, when we get back to work, when we get back to actual traffic and rush hours, to some degree. But again, is it going to go back to the previous levels? If people are Zooming, they're not driving, and so so there's the near term dynamics that are. We know that we're sloshing in oil right now. We are still looking for places to store the oil that we're producing right now. Elon Musk said a lot of wild stuff on his earnings call last week, but he did talk about this sort of transition to to electric driving cars too. So that was like sort of the long term structural change in in that market that affects oil, just to shift to more electric cars. But now you have potentially this other structural shift of people, whatever the percent. I don't know. Again, I keep saying I don't know whether it's 5% or 25% fewer people driving to work in the morning, but it's not. It's probably not going to be at the highs that we saw previously. So we know we're going to be off the peak, and that definitely has longer term implications for oil. All right, let's take our last break and we'll come back on the Macrocast.
Over the last 5 years, the Economic Innovation Group, EIG, has been a trusted source for research and bipartisan policy solutions in the Beltway and beyond. EIG recently launched the Neighborhood Poverty Project, which explores the evolution of high-poverty neighborhoods in the United States since 1980. The new research finds that while the last national economic expansion brought growth and prosperity to many areas, it failed to reverse the spread of high-poverty neighborhoods. It also finds that, increasingly, neighborhoods that fall into poverty end up staying there. EIG warns that the current economic crisis is poised to drag even more communities deeper into poverty, and calls for an intentional, place-based policy agenda to ensure high-poverty neighborhoods don't get left behind as we prepare for an economic recovery. Read more by visiting EIG.org and following EIG on Twitter @InnovateEconomy.
All right, we're back on the Macrocast. Guys, with markets up, I would say two dynamics here that, the economy, even for all of these job losses, which have been pretty dramatic, and loss of economic activity, we've seen also historic support from the government on a number of phases of plans, some still to come, by the way. We're still waiting for the Federal Reserve's programs on a couple of their lending facilities, especially their Main Street lending program, but a lot of money out there. And there's been a lot of support for increased funding. We saw about 850,000 local loss of local government jobs. In this case, we know that people are pulling for more money for state and local governments to prevent that from happening. But we've seen like a slowdown in the PPP program. It's done, pushed out a lot of money, but the number of applicants and the amount of money coming out in this week, the last couple of days, has slowed as maybe they're reaching a limit. And with the markets up, and maybe up also is a, increase in partisanship over, some of the elements in what would be a phase 4 spending plan. At the same time, I think we feel like we need to see more of that support. And I don't know where this is going to go now, whether the timing is on a phase 4 or whether if markets are way up, do we have pressure for it combined with partisanship? We may see a grinding here, and we find ourselves in the summer and fall with not the support we need to keep to keep economic growth supported.
Yeah, it's a very interesting dynamic. Having worked in the government, it is. I can say that that the pressure that markets in this administration, particularly the equity market, does apply. It is that sort of warning, that warning klaxon that keeps blaring. If the S&P 500 is falling, policymakers feel the need to act. And clearly, in this situation, the other driver was the public health situation. People in a terrible situation there. But we're not only past the infection peak and maybe the worst case scenario behind us, and markets are a lot more placid. And so, as you say, the collective feet of Congress and the administration maybe have been taken a little bit further from the fire, and it does allow for some of these positions to harden again. And we're hearing obviously the House Democrats, Speaker Pelosi wants to drive the bus on this next iteration of pandemic stimulus. And that's the White House is digging in on tax cuts. President Trump didn't get his payroll tax cut into the first CARES Act and wants to try to get it into this one. They're talking about capital gains tax as well in the White House. Senate Majority Leader McConnell is pressing on the brakes here, saying that we need a pause to assess. And he's said that before. But he's also focused very closely on the liability issue, limiting the company's liability for bringing people back to work if those people do get sick and then sue the company.
Yeah.
That's something that the Republicans in the Senate are McConnell has said that that's a must-have from where they stand. So it'll be interesting to see how the horse trading goes. And
at a big picture level, in 10 years, the risk that we on reflection didn't do enough is almost certainly higher than the risk that we did too much during the period to come. Almost 100% guaranteed. If we quote unquote do too much, and it's like, oh, we've got debt problems or something down the road, you can raise taxes and capture back if like that's the called for policy. You can't get back economic growth that never happened. That's just gone.
And when you look at at the state level, so the change in state tax revenues from April last year to this year, Massachusetts down 54%, Missouri is down 53%, Kansas 51%, Pennsylvania 50%. The best is North Carolina at 12%. These are gaps that all that money goes to pay people, teachers, firemen. So the disconnect between the market, everything's fine, and the reality on the ground, when you shut the economy, people don't spend money and you don't raise revenue,
Yeah, it is funny. I mean, the idea that equity markets kind of blowing the all clear here, to the extent that equity markets are up, and some of the pillars of that rally are government support, the big fiscal guns that have come out. The very fact that the equity market is anticipating more fiscal stimulus actually makes that fiscal stimulus less likely.
Yeah,
and it's a perverse dynamic, but I think one that we'll see how it plays out when the CARES Act really starts to come together on Capitol Hill and the battle lines.
Yeah, Tony, how do you think that this one plays out? Is it going to take a while? Do you think
I do.
In the end, especially on the state bailout?
Yeah, and one of the things that we've learned over the past, I think 10 to 15 years in government is that Congress has a hard time doing anything unless we either run out of money or we run out of the ceiling for borrowing money, right? Like we either need to move the ceiling for borrowing money, or we actually run out of money. And that's when things tend to happen. And it is like a very dysfunctional way to run government. And we've seen the same dynamic with these, with the PPP funding and phases here, where having the clock run, it's kind of like in a James Bond movie, right? With the red digital readout counting down the dollars, and we have so many days left of money, and then that's when you get action. You wonder, like, why can't you get the action, before the clock where it gets down to zero? It's very, it's nerve-wracking for people, an inefficient way of doing things, but that's the way everything happens. It's going to come down to the last minute. Well, if you use the PPP program as a proxy for that, I think we're weeks away. If you had asked us like 10 days ago, I would say like maybe by today we'd be running out of money in PPP again. They've got $120 billion still in PPP now, right? So maybe it's 40% of what was appropriated in the last amount is still sitting in there, and the size of loans is getting smaller. So this could go on for a while before we run out of PPP. If we believe that running out of PPP money is going to be the catalyst for the next one, I think that's one catalyst. I think another potential catalyst is this dynamic of state and local governments laying people off, and look, I think there are really good economic reasons why we should be supporting not just businesses but also governments to keep from laying off people. I think there are good reasons for that. You have to wonder, though, at a certain point, if the politics are going to get involved in this too, in a positive way, in the sense that nobody wants to go into elections with the economy grinding to a halt. I don't think that's good for anybody. It's certainly not good for Republicans have not wanted to support state and local funding. But if state and local governments are a big drag on the economy, their minds may change on that pretty soon, because it's not just a blue state thing. It's we're seeing it in red states also.
Yeah, so, we forget that there's a presidential election going on.
Believe it or not, it's happening, and we'll have time to get more into that. But guys, thanks for joining on the historic Jobs Day. Hopefully, there's people are going to be able to get into this weekend and know that maybe these are the worst numbers, which means the numbers will be getting better from here on out, whether they're on initial claims or regular payroll data. I think there's a long road ahead, but maybe we've seen the bottom. That would be really, really good news from here. John, Brendan, Matt, thanks for joining. Have a great weekend. Stay safe.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.